Hi, and welcome to Retire with Style. I'm Wade Pfau,
And I'm Alex.
and thank you for joining us for another episode. This week, we're going to be looking at the idea of financial attitudes and retirement outlooks. And it's going to bring together a lot of the psychological research that Alex, in part, developed with an article that we had published in the Financial Services Review that came out in early 2022. And so let's dive in, unless you have any chit chat or small talk you'd like to get to before getting into the meat of the subject, Alex.
No, that was such a clean opening. I was hoping I could find something to tease you about. Maybe you name dropped a little bit that we had an article published. I don't know whether to give you a hard time on that one or not. But I think the opening was clean, so we can get right down to it, unless you want to talk about your weekend or something like that.
No, I was just recalling the other day, like you were talking about, should we mention all these articles? And I'm like, nah. But then, but you
So
get
now you're bringing it back to me. So it's my fault, Wade. It's my fault. We're like an old married couple on the podcast. All right. No. I'll kick it off. Yeah. And interestingly enough, we started a bunch of our podcasts. We pre-recorded a lot of them, and so this is the first episode that we're recording, after we actually had our launch. And Wade, I may have to bring my A game on simply because a few of my professors from GW, I sent this out to everyone, and they contacted me about it. And so, since this is since we're talking about some psychological constructs on this one, we need to make sure that I'm on. So, there's that. And the other note that I want to tell them all is, I'm not giving my diploma back. It's too late. No matter what you hear now, it's a done deal.
That's right. And I know you really did send this podcast out to everyone you knew. And everyone who received that got a personalized message from Alex, because he did not use any sort of efficient mail merge or any other technology to speed up that process.
Yes. You of all people should be giving me tips on technology. No. All right. Here we go, right? So in the last episode, we effectively laid the groundwork on these psychological constructs that we wanted to discuss in this episode. And I'm just going to list them today just in case anyone hasn't heard them. But if you really want to get into their definition, just check out the last episode. Here we're going to talk about loss aversion. We're going to talk about heuristics in the form of financial biases. We're going to focus on hindsight bias, recency, survivorship bias, gambler's fallacy, and endowment effect. Now, what we did is we took all of those biases, if you will, and we just made them into a squishy heuristic financial bias scale. All right.
And that's what the data had indicated, was there really wasn't a difference. It was really just a general, there's financial biases people may have.
Yeah, it's interesting. I was scrolling on Twitter last week, and there's these infographics, right? The visual capitalists and stuff like that. And there are, 183 biases. I don't know how they determine 183 versus 182, etc. But yeah, what we found is that there's just a general noise, and it could have been the way we structured the scale, obviously, but there's a general noise around biases, and I think it captures it in essence. But and so our financial biases scale is really a mishmash, if you will, of hindsight bias, which is again the armchair quarterback; recency bias, which is you take what's happening now, you extrapolate that into the future; survivorship bias, you forget about the winners. You forget about the losers and just remember the winners. Your uncle that smoked all his life and didn't get cancer. Gambler's fallacy, just a misunderstanding of probabilities, expecting things to happen based on, previous outcomes, if you will. Endowment effect, what you own, you value it more than when you have it, you value it more. Hence, your willingness to sell it, it affects rationality to a large extent, really. That was effectively a lot of keystone biases that we discussed in 30 seconds. So again, no one's getting their diploma back. The next one that we really wanted to look at was inertia, which is that once you know that you need to do something, how long does it take you to do it? Numeracy, your competence with regards to numerical concepts, probabilities. Numeracy, self-awareness, and this is our shorthand for the phrase "you don't know what you don't know" kind of vibe, otherwise known as, what's it known as, Wade? Otherwise?
The Dunning-Kruger effect.
There you go. There you go. Yeah, that's numeracy self. So we do numeracy, and then we effectively ask them, "How did you think you did on it?" And how did you think you did on it relative to others? And what you find is that that sort of construct lays itself out. Retirement income self-efficacy, and that's the only caveat I always like to say is self-efficacy different from confidence. Self-efficacy is more of a localized issue, and so we specifically address it in terms of retirement income. How confident do you feel? Well, I used the word confident, right? How likely do you feel that you can overcome this retirement income puzzle of yours? And we term that to be retirement income self-efficacy. And then perceived advisor usefulness. As we mentioned in the last podcast, there's a lot of studies about the benefit of the value of an advisor, but in our world, we kind of are just putting that aside because that tends to get confused as marketing material, even though the studies are actually quite credible. We've realized we just want to get a sense of how cost effective does an individual feel an advisor is, and we term that perceived advisor usefulness. Okay? So what we're going to do today is that all these constructs that I just blitzed through, you see a lot of papers. You see a lot of these individual papers on just heuristics or just numeracy or even self-efficacy. That's something that's you're seeing bubbling up in the literature. But we really haven't seen them all together in a sort of, what's that technical word that I like to use, Wade? Is it bake-off?
Oh, your bake-off analogy?
Yeah. In a sort of bake-off, right? And so we want to look at these constructs and just see how they affect retirement investing behaviors, retirement income concerns, and retirement outlook. Wade, you want to, since I sort of held court for a little bit, you want to take it from there and maybe go into these what I mean by retirement investing behaviors?
Sure. And so we're going to be looking at two retirement investing behaviors. And one is about this idea of dividend agnosticism. Are you somebody who specifically seeks higher dividend paying stocks versus being okay going with the total market portfolio?
Does that have anything to do with religion, Wade?
No, it's not at all. It's agnostic in the sense of, in a total return investing environment, if you're agnostic about dividends, it means you don't care what the dividend rate is. You're focused on the total returns. But if you have a dividend focus, you might seek out sectors of the market that offer a higher dividend yield, thinking that may give you a better outcome for your financial plan. And that's, in practice, it's a very popular approach to take, but it's just something that hasn't really been researched in great detail. Other than, the research, to the extent that it exists, suggests maybe not really trying to focus on dividends, but instead focusing on getting the biggest total return for the portfolio is going to work better in the long term. So it's an area where, if you spend much time on internet discussion boards where people talk about retirement planning, there's a lot of people that love dividends. And we look at how does that, if you have that love for dividends, how does that relate to some of these other constructs that Alex mentioned at the start? And that's really what this aspect of the research was looking at. Now, if you love dividends, the results that we find aren't necessarily going to make you very happy or fuzzy feeling inside, because we tend to find that a preference for dividends relates to factors that you may not appreciate, like lower numeracy and so forth.
And before you give it away, let me just say, the views of this podcast do not reflect the personal opinions of Wade and Alex. They reflect the data. There you go. No. Yeah, so we want to talk about it. Let's kick off then. There's three things: retirement investing behaviors, dividend focus or not, forecasting or not, retirement income concerns, and retirement outlook. You want to kick off, since we started, how these psychological constructs are associated with retirement investing behaviors, Wade?
Mm-hmm. Yeah. And so we're talking about the dividends right now. The other one will be this idea of forecasting versus non-forecasting, but we'll come back to that. Stick a pin in that for a moment. And let's talk about the dividends first to keep some organization here.
Let me do my little two-minuter, if you don't mind, Wade, with regards to dividends. And I feel actually a little more strongly than Wade. With regards to this. I think, effectively there's not a lot of difference if you think about dividends and total return, how you're viewing it. I mean, many folks think it's a safer route simply because it looks optically like you're avoiding eating your principal since you're not selling off your shares. But if you really think how dividends are distributed, effectively when a company issues a dividend, their stock price declines by a set amount. And so it's effectively the same thing. The money is coming from the same place. You don't have more money or less money. You're effectively just moving money from one pocket to the other. So this idea of eating principal and I want to just live off of dividends, it's really more of a framing exercise from that vantage point. There's nothing there. There's no there, if you will, from a true economic standpoint. The other, Wade, agree or disagree?
Well, it's just, the dividend is just an internal way to sell some of the future value of the company by distributing it as a cash flow in the same kind of manner that someone might sell part of their holdings in the company to create a cash flow for spending.
And so that's why we didn't even discuss this in our 4 types of strategies in previous episodes: the total return, the time segmentation, the risk wrap, and the income protection. I mean, regardless of what books like The Dividend Aristocrats or whatever have you think, I mean, the reality is it's an economic equivalence, if you will. The other piece, there's some other avenues where I'm not as sanguine about it, and that's my own personal view, is you're not in control of those distributions. It's a boardroom that's in control of your distributions. And so, if you want to really match up expenses, sure, you can back into it. But, just do it yourself if you choose to go that route from a total return standpoint. And the other piece, I think gets lost in this mix, is there's certain sectors that really are more, that have dividend-focused stocks. So if you just focus on dividends, you're really narrowing your opportunity set from the entire capital market returns that are available for the taking. You're taking industry bets. And so, in a funny sort of way, even though you think you may be more conservative because you're picking these blue chip, industry, stalwart kind of companies, you're really taking some serious industry bets that, when you're setting yourself up for retirement, I'm not so sure that's the most optimal way to go about things. I'll leave it at that. Wade, you're the economist. I'm the psychologist. So did I miss? How did my response make you feel?
No, it works. It's whenever you're moving away from the total market, you're taking on more risk because you're less diversified, and traditionally dividend-paying stocks tend to be in sectors of the economy more like value and so forth, where there can be greater potential risks. So it's not less risky. In
a funny sort of way. And I do think, in terms of just listening to commercials and things like that, I do think it's a bygone kind of era, from the 50s and 60s, these dividend kind of stocks. And if you listen to the commercials, they're really pushing on it. I think it's something that's a marketing message more than an actual economic message. All right, so again, there's an economic equivalence. It shouldn't matter. Is ultimately, that's the nicest way I can say it. So from a finding standpoint, Wade, what did we find? You can say it much more, I don't know, you can say it more eloquently than I can without going on a rant. What did you find? What did we find?
Well, I mentioned that numeracy one, and that's like your numeracy score is correlated with the preference for dividends, and it's, if you are not agnostic, if you specifically want dividends, you tend to score lower on the numeracy questions, which is important. And as well, if you favor dividends beyond just numeracy, you tend to also have less retirement income self-efficacy and less risk tolerance. Those are the primary kind of negative relationships. And then this is also bad news, but if you favor dividends, you tend to also be more vulnerable to those behavioral biases or heuristics, all that list of the gambler's
Yeah.
fallacy and recency bias and all those things.
Now, I would say this is again, this is a judgment-free zone, right? Like the gym, right? Like but it makes sense that you're seeing this because I ultimately think dividends, this concentration on dividends is just how you're framing the way the income is coming in. And, that kind of does imply this sort of on a relative basis or lower level of understanding of mathematical concepts, frankly, relative to someone that's more agnostic to it. And self-efficacy, lower levels of self-efficacy with a dividend concentration could, now I'm just assuming here, so, there's caveats everywhere, but maybe there's previous failures, in this approach that have given you pause to reconsider certain things and your own efficacy with regards to that. And I can totally see the higher heuristic scores on a relative basis, if you favor dividends, because it really is just a framing exercise.
Mm-hmm.
Right? Wade, what other investing behavior do you want to quote unquote pick apart?
Yeah, I think we've got the dividends covered there. The other one is this idea of forecasting versus non-forecasting. And this is, if you're non-forecasting, that's the more like academically grounded, the idea of the random walk down Wall Street, the idea that all the available information has been priced into current valuations for companies. And so you can't necessarily forecast what's going to happen tomorrow in the markets. And so that would suggest having a more passive approach towards just investing in the total market, and to the extent that markets grow over time, being able to take advantage of that, versus the forecasting approach. That's where either you feel like you can select individual securities that you believe will outperform the overall market, or you believe you can time the market in terms of, okay, I'm pretty sure stocks are about to go down, so let me sell my holdings and go into cash. And then, I think markets are going to go up, and so let me get back into the market. That's a more active type of an approach that is popular in practice, but isn't really grounded in the academic research in terms of people being able to have success as a whole with those types of strategies.
Can I mention a couple of nuances there, Wade?
Sure.
Oh, thank you.
No,
I'm trying to put myself into folks that are listening, and hopefully there are folks that are listening. But the forecasting piece, just to be clear, it's not. Wade doesn't imply that the pricing is perfect. It's just you can't take the information that's out there, and I can't take the information that's out there, and I'm gonna outperform you, and you're gonna outperform me on that sort of informational advantage. It could be half the time overpriced. It could be half the time underpriced. We don't know. We don't forecast. We just accept market prices for what they are because they're the best estimate. They're not the correct one, but we take it at that. Now, this in and of itself is a whole string of podcasts, so I'll leave it at that. And with regards to the forecasting, some of you may be thinking, "Oh, I'm not a market timer." You need, it's important you check yourself with regards to that, because when we see a lot of prospects, we talk to a lot of folks, even our clients, and you get a lot of the "I'm not a market timer, but," I'm not a market timer, but as Wade and I are recording this, there's an issue. Obviously, the Ukrainian situation is rearing its ugly head, unfortunately. And the reality is I'm not a market timer, but this thing is just too crazy. I'm going to step away. COVID. I'm not a market timer, but COVID. I'm out of here. So really, it's important to check yourself. Yeah, you may not be the day trader, with meme stocks, but by the same token, it's almost as insidious if you're this sort of tactical forecaster based on these macro events that you think, I'm going to go from a 90% equity to 60% equity for the next 3 months. Or for the next 2 years. That can come back to haunt you. Sorry, Wade. I just think that's important because it's just contextually it's one of these things that there's always this back and forth with folks.
Yeah, and I think you see that in the historical data too, whereas like we could already see with the COVID case, if you panicked in March 2020 and left the markets at that time, you missed out on that quick subsequent strong recovery. And that's the kind of thing that if you just stay the course with your strategy over the long term, that's what the academic evidence suggests, that sort of passive stay the course philosophy is going to win out in the end.
And just to bring it back to what we're doing, remember, this is an overall podcast on retirement income. So this is where we acknowledge that we are going to face volatility, sequence of return risk. That's where you have to make sure that your strategy, we're kind of, in our conversations, we're talking about somebody that's really tethered to the market. So if your strategy is total return, it's part of the game. It's not a platitude that we're saying don't worry about it, but it's part of the expectation in your approach.
Mm-hmm. Okay, so let's talk about how your views on forecasting versus non-forecasting relate to these different constructs. So if you're a forecaster, this is like you can time the market or you can select winning stocks or whatever the case may be. You're more vulnerable to having, I mean, a lot of this is the same as with dividends. Like if you're a forecaster, you're more vulnerable to financial biases. You're going to have lower levels of numeracy, and you're going to have less retirement income self-efficacy. And this is all correlation. So on average, in the typical case, there can be exceptions. And you also may seek more professional guidance, actually, that if you're a forecaster, you may have greater perceived advisor usefulness. And any flavor or comments on those are the main findings?
Yeah, I think it's interesting to me. What I come back to, it kind of makes sense. If you're more active and tactical, you're effectively trying to set pricing, if you will, by picking stocks or moving stuff around. It's easy to see why it makes you more vulnerable to financial biases, because you're leaving yourself open to hindsight bias. You're leaving yourself open to recency effect. Look, when you have all these biases, if you look at the outcome, the end result is there's nothing you can do about them. You just have them, right? And so then it goes back to controlling your environment. Ultimately, and I get the phrase, the space between stimulus response is your freedom. I think that's Frankel or something along those lines. But the reality is that control your environment, and you put yourself in situations to succeed. And if you're in this active forecasting bent, you're really just getting bombarded, with a temptation to react to your human nature, through these biases. And so I totally see why, on a relative basis, there's a greater vulnerability to this. Lower levels of numeracy and numeracy self-awareness with regards to forecasting. Well, I mean, if I take self-awareness, if you really are picking stocks, I think there's a sense of humility that's, it's the wrong word. Let me say it the other way. If you're a passive investor, there's this humility that comes with accepting market prices. Like, it is what it is, kind of, and this is the best I can do. I don't think that's present if you're forecasting. Forecasting, at the end of the day, you're kind of saying, I'm smarter than the guy next to me or the woman next to me, and I get the joke much quicker than everyone else. And so I can see where you have that self-awareness. And then numeracy, I mean, if it's easy to just say, hey, like you said, Wade, if you look at the historical numbers, I mean, wait, if you're the department chair and someone comes up to you, a grad student comes up to you wanting to do a dissertation on how active management underperforms passive management, what would you say? You'd say, no, Christopher Columbus already, no, and I don't know who, the things have already been discovered. It doesn't matter, kind of thing. And so there's, I don't know, maybe this is too much of a stretch, but if you can read papers, if you can understand basic stats, you realize that the odds are strongly against you, from a forecasting standpoint. And if you want to roll the dice, be my guest. The world needs price takers as much as price setters, but to some extent, it's a difficult challenge. And so, why would that also, look at why would you have lower levels of self-efficacy? There's probably a lot of failure involved in it. Which then translates to why you may want to see an advisor, because at a certain point you just throw your hands up in the air. Again, the last 2 points that I'm saying are just conjecture on my part, but it follows that narrative.
Mm-hmm.
Wait.
Yeah, and so did these individuals who are forecasters have that Dunning-Kruger effect where they felt like they knew more than they did?
Yeah, which makes sense, right? There's that I'm the smartest person in the room kind of vibe. Now, I say that, I don't know, I'm kind of trying to be funny, but not at the same time. But yeah, there's that sense of it. I think there's a level of humility that's needed. And again, with regards to retirement income, you got to think about what's your end goal here. And so you see that this is an investment behavior that could set you back, in a significant manner. And so this is what we see. The people that attempt this is what you're finding. And again, this part is not our opinion. This is just how it lays out.
Mm-hmm.
All right, so that's investment behaviors.
Yeah, so let's move on to retirement income concerns. And that's the 4 L's, although it turns out a lot of people are not really worried about legacy, so we'll talk instead about the 3 L's in that case, which is the longevity, which is you want to make sure you can cover your basics no matter how long you live. Lifestyle, which is more a sense of you just want to maximize your overall lifestyle and you don't want to have any regrets that you didn't spend or take as much advantage as you could in life. And then the liquidity, which is you want resources to cover the unexpected things that can happen where you may have a big expense, whether it's healthcare related, whether it's having to replace a roof on your home, but you're just the liquidity to cover these sort of unexpected events. And we want to look at how these relate to the different constructs that we talked about at the beginning of the episode.
Yeah, and the big winner here seems to be self-efficacy. I mean, biases had some effect, but we're just focusing on the ones that didn't. So we don't talk about inertia, it's just because it didn't come up, if you will. And here what we found is low levels of self-efficacy are strongly related to longevity concerns and liquidity concerns. And high levels of self-efficacy is strongly associated to lifestyle concerns. For me, Wade, I don't know about you, this was curious, and I'm thinking of the world from a hierarchy of needs of sorts. Obviously, everyone is to some extent thinking about longevity, not running out of money, etc., even at high net worth levels. But it seems to me that there seems to be a graduation that you need in terms of these concerns. Like longevity and liquidity concerns, are just grouped with this low self-efficacy. And I don't know, it's just a strong sort of feeling, a visceral feeling. It seems like you got to, from a concern standpoint, before you get to lifestyle concerns, you need to cross the longevity and liquidity bridge. You follow what I'm trying to say?
Right.
It's like an interest. There's
You're
an
more
order.
concerned about the basics.
Yeah. It makes sense, right? There's an order of operations, if you will, and it's just kind of cool how efficacy graduates through that order.
Mm-hmm. Yeah, if you're that low self-efficacy, it's just you're worried more about these basic considerations, your longevity and your liquidity. And if you have high retirement income self-efficacy, you feel like you've got control over those basics already. So it's not that they're not important, but you're not just concerned about them. You're more concerned about that lifestyle component of getting the most enjoyment, most spending power out of your assets to enjoy the highest possible standard of living.
Yeah, and I think you tie into that the other construct that was significant again, these are correlations right now that we're looking at, was the associations of levels of financial biases with longevity and liquidity concerns, which make more sense. To me, I see that as, you probably are concerned about longevity and liquidity having high financial biases simply because you may have had a tough go at it so far. And so you're like, man, am I going to get it together? And run through the tape here? Or is this going to be something that's going to be a continual, rinse repeat exercise. And so that's a kind of interesting. I don't personally want to make too much out of this way just because it's just correlational data at this point, and it's more, hey, look at this cool little finding. But that's what I see. I can't read more into it than that.
Right, and by no means are any of these universal statements. It's more just a tendency that where these different issues show up together. But the final thing we want to talk about today is this idea of your retirement outlook and controlling for your characteristics, your age, your gender, your marital status, your net worth. Are you satisfied with your nest egg? Are you satisfied with where you're positioned for your retirement is one issue we want to look at. And then do you have anxieties about your retirement income plan?
And Wade, the only thing I'd like to say here is that Wade did allude to, we controlled for various factors such as age, gender, marital status, and net worth, but we also controlled for all of the other internal psychological variables. So we did put them all, this is the closest thing to a bake-off now, because we put them all in the same sort of analysis. And so if self-efficacy and financial biases, are kind of explaining the similar variation in an outcome, and self-efficacy is stronger, self-efficacy will drown out the biases, that kind of thing. And so this is where you really get to see, which one kind of sticks, which one hangs a little bit better in explaining, these outcomes. And again, we're using nest egg satisfaction and retirement income plan. But I think that's important. Now we've moved on from correlation on. This is more everything out. I don't want to be too nerdy here, but it's just everything at once. That's the best way I want to say it right now.
Mm-hmm. And so with the nest egg satisfaction, if you're satisfied with your nest egg situation, you tend to have higher retirement income self-efficacy. And that's the big important finding there. The other one is more with those demographic type characteristics. People who do have higher net worths also tend to have higher nest egg satisfaction.
Which makes sense, right? But even controlling for net worth, it's important how self-efficacy was this strong variable. So if you've noticed throughout this presentation, podcast, this sort of self-efficacy variable seems to be coming up a lot. All right, it seems to be an important variable. It seems to me with regards to a lot of these retirement income, outcomes. Retirement income anxiety. Wade, what did we find there?
Well, so it's kind of similar with the self-efficacy, as you said. It keeps showing up, but if you're more anxious about your retirement income situation, that means you have lower self-efficacy, which makes sense in this context. You don't feel comfortable with what you're doing there, and so you have more anxiety. And then also, if you have more anxiety, then you tend to display more of these financial biases as well as inertia, that you're more vulnerable to these types of issues, which, because then with lower self-efficacy, you're just not as comfortable with. Well, you're anxious.
Think about it.
Anxious with this situation.
Makes sense, man. This is like inertia. Take inertia. This is where, let's say you've just retired and you realize, man, I gotta now develop a plan. 2 years later, there's no plan, right? And with those 24 months that get you to 2 years, there's nerves that come with that. Like, man, I gotta do the plan. I gotta do the plan. It's that little voice in your head that keeps on, ringing. And so to that extent, I can totally see why that would lead to retirement income anxiety. But again, in terms of what we did here today, is we really looked at all of these factors, and we wanted to see together, how do they hang with each other? In terms of investment behaviors, I think the dividend stuff in itself is its own, research project kind of thing, Wade. But we saw that with investment behaviors. We saw that with retirement concerns, and now we see this with like your outlook, right? And so leading into here, we really want to now set the stage for the next episode. In the next episode, what we want to do is take these factors that we think are important. Obviously, self-efficacy is one, and we want to take another factor here. I'll leave it alone for now, and see how in combination these two factors, in much the same way that we were able to create a RISA matrix to identify what strategy makes sense, we can really do something interesting from an implementation. We take retirement income self-efficacy and we take variable X. This is my way of doing a cliffhanger, Wade. Let me know how effective I am. And we create a matrix off of that, and it's a financial implementation matrix, which was very predictive of 4 specific implementation personas that we'll get into. Because I think it's very important. I mean, you can have the strategy down to a T, what you want to do. But if you don't implement, if you don't move forward, it doesn't matter. So we'll get that in the next episode. For me,
That's right.
Thank you for listening. Wade?
Yeah, thanks everyone. Have a great day.